We know that new all-time highs are coming. Everything is pointing in the right direction.
Hi, Matt. Thank you so much for being on again.
Robin, thank you very much for having me back. It was great to be on last time. Had a lot of great feedback and big fan of your channel as well. And especially after catching up quite recently in Vegas and getting to know you in person a little bit, I was excited to come back on.
Awesome. Yeah, really cool. It's so fun to meet people in real life and having that connection there. Because have a hard time sometimes recognizing people in person when I only saw them on screen. But it was really fun hanging out. I think we also saw each other then on the airport again, or only on the airport. I'm actually not sure. Like Vegas was like one blip for me.
Yeah, the thing is, when I saw you, you're maybe the easiest person I've ever known to spot, because I was walking through the airport and you see someone who's like 2 meters tall and it's like, oh, there's Robin, I'll go say hello.
Yeah, and I sometimes have even my name written on here. That makes it super easy. Yeah. But for the few people that haven't seen you or haven't seen your content, maybe give us some overview of who you are and especially why you're excited about Bitcoin.
Yeah, of course. So my name's Matt, and I'm the lead analyst for Bitcoin Magazine Pro. So we're the data and analytics branch of Bitcoin Magazine, who do the publications, but also host all of the conferences, do Bitcoin for corporations, and that type of thing. So we're just trying to simplify a lot of the data surrounding Bitcoin, specifically in terms of the on-chain, and now expanding into kind of macroeconomic data. I think a lot of people kind of get paralysis by analysis. They see that there's 1,000 different charts you can look at. And especially I was the same when I first got into Bitcoin and trying to learn everything. It can be pretty confusing. So we're just trying to provide the simplest charts that really you need to know, whether you're just a dollar cost averager, whether you're someone that's just interested in Bitcoin, or maybe you're a bit more of an active market participant. We're just trying to provide charts and data points that can help everyone.
Really, really cool. And I think last time we spoke was like earlier this year, if I had to guess. So like about half a year ago, or maybe a little bit longer than that. What has changed in the current environment, and how is like kind of the market doing, maybe also compared to like half a year ago, and how are things going?
The thing is to be honest, I think everyone watching this and everyone who's in Bitcoin is seeing these new all-time highs. And it's pretty bizarre because they just feel like an inevitability now. I mean, in previous cycles, if you saw Bitcoin break into new all-time highs, there was just peak euphoria. Everyone was just over the moon. But now it's just like, right, we know that new all-time highs are coming. Everything is pointing in the right direction. So when we hit them, it just feels like an inevitability. I don't know, it doesn't quite have the same excitement. And I'm not sure if, again, that's maybe due to the price action we've seen this cycle. In previous cycles, if you look at the 2017 bull market, you have this big euphoric run up with big volatile swings. Whereas this cycle's been a little bit more, let's be honest, boring, where we've had this long period of choppy sideways consolidation, big explosive move to the upside or the downside, and then another few months of just sideways price action. So in terms of the on-chain data perspective, not a lot has massively changed. I think we're getting a little bit more clarity on how the remainder of this cycle may play out, especially considering correlations to previous cycles and patterns we're seeing in kind of investor behavior when looking at the data. But ultimately, things do look pretty good. It's one of these things where everyone wants to look at these charts every single day and look at what's changing. But a lot of these cycles take months or even years to play out. And so you're seeing the data saying kind of shifting into this more bullish latter stages of the market narrative. But ultimately, things are looking pretty good. And I'm definitely very bullish and positive on the outlook over the coming months.
Yeah, one thing that I've definitely noticed is in the past cycles, there was more of boom and bust. And now it seems to be more like stairways climbing. So it's like, yeah, like a little bit of sideways. Now we're like going up again, and it's like consolidating. And so I think because we don't have those huge uprises and huge down crashes, and also the market participants are just like very different. We have now the sailors and the BlackRocks of the world into Bitcoin versus the everyday guy that might be more inclined to FOMO in when the price goes up and to panic sell if the price goes down. So it's really interesting for me to compare like this cycle to even last cycle. And I don't know if you see the same thing, but I feel like the boom and bust gets like a little bit more just like climbing and climbing. We are kind of getting away from an exciting new startup tech stock to the S&P 500. I don't know, we are not there yet, but it's like it seems like we move in that direction.
Yeah, 100%. We're seeing this diminishing volatility where institutional inflows, just maybe not as much retail participation either, is just, as you say, kind of dampening these big violent swings we've typically had in price action. And I think that's something that we can maybe talk into a little bit more on this podcast, in that a lot of people are saying, is this time different? Because of course we're seeing institutions coming in, Saylor coming in and buying hundreds of thousands of Bitcoin, Metaplanet, etc., all just trying to pile into Bitcoin. Now, a lot of people are looking at this supply being accumulated and thinking this might never hit the spot market again. So maybe we're not going to have these big bear cycles like we typically do. Maybe we still see these 30, 40% retracements, but maybe Bitcoin now is going to decouple and be this independent asset and go into this big super cycle of multi-years. But looking at the data, again, I don't like to be a bit of a party pooper, but we're not really seeing that just yet. Now, of course, I do think there is a growing influence of institutional participants, and that is changing the supply and demand economics of the network, and we're seeing that in the price action. So I do think that the cycles are going to change going forward. Maybe we're not going to have the same typical 4-year cycle like we historically have done. But if you look at kind of the ETF inflows, for example, I know these aren't specifically just institutions buying and selling when we look at the ETFs, but the correlation between their inflows and outflows and something like the Bitcoin funding rates is actually pretty high. So even though we're seeing more and more smart money, big capital coming into the markets, they're actually behaving kind of similarly to how they have done in previous cycles, because everyone's still susceptible to these big emotions, these periods of euphoria and greed. Everyone still likes to FOMO in, everyone capitulates in the bottom, regardless of how big their wallets are. So we do have some data to back that up, which I think could be interesting, because that's probably one of the most talked about points of discussion we're seeing on our channels and social media. Is this time different? Are we going to have this big super cycle? Will I ever be able to buy back in lower?
Yeah, that's it's always, for me, an interesting question also is for all the people, is 2026 being a down year? Because that's people always, I know, for example, I'm a lunatic and I just buy Bitcoin. I have 100% in Bitcoin. Like I don't do anything with my Bitcoin. But I know a lot of people, and even my mom asked me, "Oh, is now a good time to buy? Like, oh, should I wait like half a year because I can wait also because I'm not all in like you." So I hear that from my direct environment, but also in the comments and from people in general, and they're wondering, oh, like how much higher are we going, and especially will 2026 be a down year for those people that maybe also do lending and all those credit things. It's highly relevant. That's why I don't do it, because I don't want to be in, I don't want to be dependent on like where the price and the market is going. But I know a lot of people actually do that. So this is I think why the super cycle talk is interesting, because if we now have different buyers and sellers in the market, and they are more inclined to just buy over the long term or not really sell, does this mean that we are going slower up but more consistent up? So maybe we don't have a 2026 down year, because like I think 2026, if we follow the 4-year cycle, like up down, up down, and so on, then 2026 would have been a down year. What can you see on that front, and maybe also like how the cycle changed?
Yeah, I'll just share a chart here so that we can maybe discuss a little bit. So this is just looking at the current Bitcoin cycle in comparison to the previous cycles. Now, this is one of these things where I like to be pretty boring and just stick entirely to the data. We all have our own personal interpretations and opinions on how things might play out. And if I'm kind of being honest of what I think will happen, but not based on the data, I do see this cycle slightly extending. We have seen diminishing returns in every cycle, and again, expect to see that trend continue. But if we weren't to see lengthening cycles, then this cycle would peak at around October 19th of this year, which would only give us a few months left of this current Bitcoin cycle, just looking at the previous cycles as inspiration. But like I said, I feel like we may be seeing lengthening cycles. If you look at sort of the 2020 to 2021 cycle as the kind of most recent comparison we had this big double top of price action, which kind of caught a lot of investors off guard. I think a lot of people, after we had this first peak and started to run back up against new all-time highs, were maybe expecting 100,000. And a lot of the on-chain data points kind of did top out in this first peak. So it did throw a lot of investors off in that regard. But this cycle has actually shown something slightly different to that still. So if I go to the value days destroyed chart here, so this might look a little bit more confusing, but it's actually a fairly simple chart in terms of its calculation. So what this is doing is looking at something called the coin days destroyed. So what this is doing is essentially weighting the velocity of Bitcoin transfers. So if you see big whales transferring huge amounts of Bitcoin, this is when we have these huge spikes to the upside. Now, if I was to hold one Bitcoin for 100 days and then transfer it, it'd be 100 coin days destroyed. If I held zero point 0.1 for 1,000 days, it'd be the same. So we're really weighting the profit taking by these long-term experienced Bitcoin holders. Now, what we can see is they typically have a fairly big influence on the Bitcoin price action. They're usually taking profit towards peaks, not necessarily big cycle peaks, but as Bitcoin is having these big euphoric moves to the upside. Now, what we can see in previous cycles, such as the 2020, 2021, like I said before, we almost had this double top as Bitcoin's price action peaked. We had this huge wave of investors taking profit on their positions. And then a little bit later, as we had the second peak, again, a little bit more profit taking. Value days destroyed might not show this as well as some other charts. I'll maybe show a few there, such as the long and short term holders as well after this. But if we look at this cycle, it's actually been a little different in that we've had this big run up to the upside when we had this ETF announcement when we ran up to about $74,000. And then following that, we had about 6 months or so of just boring, choppy, sideways consolidation. Then we had this first break of 100K. And then again, we had multiple months of Bitcoin retracing, having a little period of drawdown and just a little bit of general capitulation as we retested the previous high. And then now we've again had this big run up to new all-time high. Again, a little bit of profit taking from long-term investors. And potentially now we're going to see this long drawn-out cycle again. So like you said previously, we're having this almost stair action of price where we're having these big sideways moves, big run up, everyone takes profit. Investors are allowed to recompose themselves, new capital is allowed to flow in, a new foundation, a new baseline is set at whatever that price floor is. And then we have this big step up again. So we've actually seen something recently here. And again, I don't think this is necessarily indicating that we've had this cycle peak already. If we look at something like the 2017 peak, we had lots and lots of these very high spikes on the value days destroyed multiple. But it is indicating that the market cycle has changed and could potentially be stretched out to some extent because we're having these long periods of consolidation where investors can kind of allow themselves to feel like they're getting value for money again. Because if you look at 2017, if you see the Bitcoin price action at $10,000 and a few weeks ago it's $5,000, you maybe don't think you're getting the best value for money. But especially now, if we're seeing institutional investors scaling into the market, regardless of price action, if they're seeing Bitcoin as a portfolio asset where you don't need to hold 1 or 5 or 10 Bitcoin, but you need to hold 1% or 5% of your portfolio in Bitcoin, then suddenly you're going to be scaling and regardless of price action. So that's going to diminish the volatility. And then once we're seeing these big run-ups to the upside in price action, and then price has these very stagnant periods, again, it resets expectations. People aren't thinking, oh, wow, no, I'm not getting value for money anymore because Bitcoin's price action has been 60K for multiple months. They think, well, this probably isn't a bad area to scale in. Or price has been 90K for multiple months. Or this time it might be 110K for multiple months. And then at that point, people say, yeah, I feel like I'm getting value for money here. So I do see this cycle being different, but that is my personal opinion of what could play out. As I always like to say, just pay attention to the data. If we start seeing warning signals, the market is just purely based on supply and demand economics. If we're seeing lots of people taking profit, if we're seeing lots of people over leveraged, if we're seeing retail foaming into the market, these are the times where you need to be taking profit or maybe just scaling back your accumulation of Bitcoin because you may not be getting the best risk to reward on that position. But as I said, it's just one of these where if we're at 130K, if we're at 230K, when the signals start flashing, that's when I'm going to be taking action.
Can you explain to me again what VDD is, so like values days destroyed?
Yes. So as I said previously, it's based on the coin days destroyed. But what we're doing is taking a 30-day average and comparing that to a yearly average. So again, a lot of people look at metrics such as the MVRVZ score. I'll just very quickly pull that up so you can have a comparison. And we'll look to on-chain data and say, maybe it's not going to work so well going forward because we've had these diminishing peaks in the data. So the MVRVZ score, I know I've gone a little bit off topic here, but this is comparing the realized price or realized cap of Bitcoin, which is the average accumulation or cost basis for all investors on the network, to the underlying price of Bitcoin. So what we can see is in the previous cycle, we had a much lower peak than we had done in the previous cycle. So a lot of people may be looking at this metric and thinking, I don't know if on-chain data is going to work so well. So that's why I really like metrics like the value days destroyed, because this is based on a rolling yearly average. So even as the dynamics of the network change, even as we're seeing supply not moving, even as we're seeing institutional accumulation, this metric is going to account for these changes in dynamics. So what this is doing, as I said, is just looking at the coin days destroyed, but then changing that into US dollar terms and then dividing that 30-day average by a yearly average. So you can almost see on the most recent monthly basis, are people taking considerably more profit than they had done in the previous year.
Well, and what is the coin days destroyed?
So the coin days destroyed, I can just go to the chart quickly here. This is weighting Bitcoin transactions by the amount of time it had been held and the amount of Bitcoin being transacted. So if I transferred one Bitcoin after holding it for 100 days, then that would add 100 coin days destroyed. Recently, we actually had this big whale transfer 80,000 Bitcoin after holding it for just over 14 years. So this obviously had a huge influence on a metric like the coin days destroyed, because we saw a huge amount of Bitcoin being transferred after an extended period of time. So I know I'm going slightly off topic again, but many people may look at the coin days destroyed or something and say this is a huge amount of profit taking by big long-term investors. But I actually have a chart here which is something slightly different. So again, I know going on a bit of a tangent here. When we accumulate all of the coin days destroyed on any given day or any given average, it can be influenced quite strongly by one individual's transaction or one big movement by an exchange or something. So what this is looking at is, rather than the amount of Bitcoin being transferred by whales, it's actually the number of whales transferring Bitcoin. So again, it might be a little harder to see, but when we have these big spikes, it not only indicates that there's a huge amount of Bitcoin being transferred, but it's actually being transferred by a huge amount of Bitcoin whales, to kind of give us some indication that not only is price exceptionally high and we're seeing a lot of Bitcoin moving, but this is the general consensus by a lot of the market's most experienced players. Whereas right now we're actually at a value pretty close to 1. This is a 28-day average of this metric. So we're seeing a lot of Bitcoin being moved on chain, but this was heavily influenced by certain individuals that maybe warp the data a little bit. So it does take a little bit of personal interpretation, but the value days destroyed, I think, does still give us a really good indication of where we could be in a cycle.
Oh, so basically it shows if there's a lot of coins moved that also haven't moved for a long time, then it shows that people are kind of taking profits and kind of moving the things. So if the multiple is very low, so the green area is there, this just means people are holding on to the coins and waiting for like a higher price in the future.
Exactly, yeah. And I know a lot of people will say, oh, but these are just coins being transferred on chain. We don't necessarily know if they're being moved to sell. We don't know if they're being OTC moved or collated in different wallets. And that is true. We don't necessarily know for certain that when coins that haven't been moved in 14 plus years are being moved, that they are being moved to be sold. But generally speaking, we can look at network activity and see a huge increase in old coins being moved towards cycle peaks, and we see a huge diminishing in that value. We see very, very few old coins being moved when we're at bear cycle lows. So even if it's not an exact science, we can say with some degree of certainty that when whales are moving coins and are interested, it's usually as we're approaching a little bit of a local peak in price action.
Is it if coins are moving in general, or do they have to move to an exchange or something?
Just being moved in general. So this is the thing. This is why it's not a perfect science, because we can't say for certain that they're being moved to an exchange. Again, people may be moving coins to an exchange just to stake them and earn some percentage reward, or take out loans against them, or whatever they may want to do. But this could be Bitcoin being transferred from my wallet to your wallet or something. Just anytime we're seeing Bitcoin being moved on chain, we're aggregating all of this data when we come up with a lot of these on chain data points.
Yeah, because I was thinking like now I'm in Bitcoin now since 5 years, and in those 5 years I've moved all of my coins multiple times as I upgraded my security. Like, so like I didn't do anything with my coins, just like first I just bought a ledger. I should have some multi-signature. Oh, this and that. Like I don't know how many times I moved my entire stack or like part of my stack in different kinds of settings, just because like I want to increase my stack. But I guess it's still a good indicator, because it shows how much activity is there, and if there's a lot of activity and they move it a lot, it shows that, yeah. But it's also interesting how this will change, because as Bitcoin grows in value and it will be a bigger and bigger part of people's portfolios, people might also want to start just spending it and just using the Bitcoin. For example, I have now a spending wallet where like the coins move like every fifth day or something like that. And if this gets more and more popular, it's interesting how those will influence also those metrics. I mean, I guess right now most people just use it to store their wealth, and are not, again, a lunatic like me.
Yeah, yeah. So of course we are seeing kind of again a shift in narrative of Bitcoin. Previously, I was just really quickly showing the value days destroyed having a spike at the tail end of the last bear market after the FTX collapse, because again a lot of people would have been moving their coins off of centralized exchanges onto ledgers. So again, there are some instances where we need to kind of interpret the data a little bit more. But in terms of Bitcoin's narrative changing, again, I think this is a great topic to discuss. So I'm just going to once again try and share my screen. So when Bitcoin, when the white paper was first written by Satoshi, it was, I always get the exact ordering the wrong way. It was an electronic peer-to-peer cash system or something like that. Either way, we're seeing less and less Bitcoin actually being used for that. I think the narrative has shifted into a more store of value asset, which makes sense. No one wants to be the next Bitcoin pizza guy who spends $100,000 on a couple of pizzas, or millions of dollars it is these days. So if we look at something like the miner revenue in fees, we can actually see, if I just zoom in here, that the amount of revenue that Bitcoin miners have actually earned in block reward fees, not block reward, in fees in the block from Bitcoin being transferred on chain, we can actually see that this revenue is the lowest it has been since about 2012. So over 13 years ago was how long you have to go back to actually see miners earning as much Bitcoin in revenue than they have today. So I just think, again, this really explains how Bitcoin is changing a little bit. And this is why we can't really just focus on just the on-chain data, because if we're seeing, like we discussed previously, institutions, Saylor, big high net worth individuals accumulating Bitcoin, maybe with no intention of ever taking profit on that, then we need to look at Bitcoin through a slightly different lens. And this is where I think the ETFs have actually been really good for Bitcoin data, because if we just look at the ETF cumulative flows, for example, again, this is the cumulative. If we looked on a day by day, it looks fairly similar to the Bitcoin funding rates. This gives us another lens that we can actually analyze the market through. So previously in 2016, 2017, and the last cycle, we of course had the on-chain data. But if more people are putting their coins on exchanges like Binance or wherever they're trading, then again, we don't necessarily see exactly what those coins are doing. Whereas now with the ETFs, we can look through Bitcoin through the institutional lens, where we can see what do big money players think is upcoming in the Bitcoin price action. If they're heavily accumulating, then there's probably anticipation of higher prices. And if they're starting to offload some of their positions, again, maybe they're anticipating further downside, being a little bit more defensive. So now that we can actually observe and analyze Bitcoin, not through just on-chain data, but looking through institutional or ETF accumulation, as well as that, we have derivative data. Like I said, the funding rates previously have a fairly big correlation, fairly strong correlation with the ETF inflows and outflows. Again, we can look at Bitcoin through this derivative lens. We can look through a macroeconomic lens if we look through something like global liquidity. And along with that, we have technical if people are actually just trading based on the price action and charts. So there's multiple different lenses we can really analyze the market through. And I think that's when I personally make my best investment decisions, when I see confluence, when I see lots of indicators all pointing towards the same thing. If we're seeing Bitcoin funding rates incredibly high, everyone going very leveraged long, if we're seeing a huge amount of whales taking profit, we're seeing retail FOMOing in, all of these kind of point towards potentially a local peak in price action. And again, I often get a lot of slack because I'm quite open by saying I am going to take profit on my Bitcoin position at some point. I'm going to start selling, not 100%, but just a small portion of my portfolio. I'm going to try and sell so I can reaccumulate at lower prices. But you don't necessarily have to do that. You can just not scale in as aggressively when the market is maybe getting a little bit overheated. Just give yourself a little bit more value for money, a little bit more bang for your buck when the market is potentially a little bit of a discount.
And then right now you're seeing that you might have the chance to buy back lower from here.
Yeah, so we'll go on to kind of what we're currently seeing in the market. So, of course, we broke to new highs above $120,000, and I was kind of a little bit wary of how much higher we could immediately go. So, we were seeing the Bitcoin funding rates at fairly elevated prices, the highest sustained funding rates that we'd seen in multiple months, pretty much all of this year, really. And now what these are looking at is the amount of interest, essentially, that perpetual derivatives futures traders are paying just to keep their position open. So on any of our charts, I know I'm just, of course, using Bitcoin Magazine Pro charts, but on any of them, if you want to understand a little bit more, you can just scroll down and get a little bit more insight into how these actually are calculated and the logic behind these charts. But we were seeing incredibly elevated funding rates. Again, even though we weren't seeing a huge number of individual whales actually taking profit on their positions, we were seeing metrics like the coin days destroyed getting slightly overheated. And of course, that resulted in the value days destroyed, giving us slightly overheated levels as well. If we look to something like the short-term holder MVRV, so this is just the average accumulation price or cost basis for new market participants. And then when we look at the market value to realized value of that, the realized price to the actual underlying price of Bitcoin, we could again see that this was getting it slightly higher than we had been for a few months. So when we put all of these together, it maybe gives us a little indication the market isn't necessarily due for a big retracement, but potentially a little bit of cool off time. And we have seen that. We've now had a retracement to around 111,000. I think the local low was recently. And this is pretty typical, pretty normal. All we've done is gone back, retested the previous highs we'd set, and now we're kind of just already seeing a little bit of a strong bounce and reaction in the Bitcoin price action. This is very typical, very normal for a Bitcoin bull market. If we look back to 2017, we were having retracements of 30, 40, 50% fairly regularly. And they were coming back and touching this short-term holder realized price level, almost a moving average of support and resistance throughout Bitcoin bull and bear cycles. So now we're just coming back here and we're getting pretty close to this realized price. It's obviously trending to the upside as people continue to accumulate above this average. But if this starts to reach about $110,000, if we start to see the funding rates again, maybe turning negative or a lot more neutral, we see a decreased amount of profit taking from long-term Bitcoin holders. All of this would kind of point towards the market potentially getting to a point where it's looking much more favorable for some accumulation, much more favorable risk to reward for trying to actually buy in once we've got confluence from multiple data points, all saying that maybe this time of consolidation is over and we can actually now continue to hopefully regain new all-time highs.
Thank you for watching this video. This was only a snippet of the podcast. And if you want to watch the full episode and get all of the context of this episode, you can click right here or here. Oh, maybe also here.